Robert Kiyosaki just pulled off one of the most impressive calls in precious metals history, and almost nobody is talking about it. On December 27, 2025, when silver was approaching $80, Kiyosaki celebrated with his followers. Silver to break $80? Happy New Year, smart silver stackers. Your patience has paid off. Now we get richer. Silver is hotter than gold. One day later, December 28th, he completely reversed tone. Silver bubble about to burst? I love silver. I bought my first silver in 1965. But is silver bubble about to burst? FOMO, fear of missing out. Mania crash is coming. If you are planning on investing in silver, be patient. Wait for a crash, then go or no. 24 hours after that warning, silver touched $84 and then collapsed 11% in its steepest single-day plunge since September 2020. Within 3 days, silver had fallen from 84 to 72. Kiyosaki's warning about FOMO mania crash was vindicated almost to the hour, and on December 29th, as silver was falling, he posted again. Silver breaks 80 hours, $200 next. Now, February 28th, 2026, silver is back above $90. The crash he predicted happened. The recovery he predicted is happening. And the $200 target he set is starting to look less like hype and more like the kind of call that people remember for years. Let me show you the complete timeline, why his warning mattered, why he was right to issue it, and why his $200 then $500 targets might actually be conservative given what we now know about supply, demand, and the structural forces driving this market. Start with Kiyosaki's credibility because this is not a random internet personality making predictions for clicks. Robert Kiyosaki is the author of Rich Dad, Poor Dad, one of the best-selling personal finance books of all time with over 40 million copies sold globally. He has been buying silver since 1965, which means he has lived through 6 decades of precious metals cycles. He experienced the Hunt brothers silver spike to $50 in 1980. He experienced the 2011 run to $48. He experienced the 2020 COVID crash to $12 and the subsequent rally to $30. He has seen every pattern, every mania, every crash, and every recovery that silver has produced in modern history. When someone with that much experience and that much skin in the game issues a warning about FOMO mania 2 days before an 11% crash, you should pay attention. Now let me walk through the exact sequence of his calls because the timing is what makes this so striking. December 27th. Silver approaching $80. Kiyosaki celebrates. Smart silver stackers. Your patience has paid off. Now we get richer. Silver is hotter than gold. That is classic late-stage bull market exuberance. Everyone is celebrating. Prices are rising. Fear of missing out is building. And Kiyosaki, who owns silver mines and is deeply invested in the metal, is publicly celebrating with his followers. December 28th, 24 hours later, Kiyosaki posts a complete reversal. Silver bubble about to burst, FOMO, fear of missing out. Mania crash is coming. If you are planning on investing in silver, be patient. Wait for a crash, then go or no. He goes from celebrating smart silver stackers to warning about a bubble and advising patience. That is not hedging. That is a specific, actionable warning issued in public where he could be proven wrong within days if the crash did not materialize. And he was not vague about it. He said crash is coming, not might come, not could come, is coming. December 29th, silver touches $84. Hours later, the collapse begins, 11% in a single day. The CME raised margin requirements on silver futures from $20,000 per contract to $25,000, forcing smaller traders without sufficient capital to close positions or face automatic liquidation. That margin hike was the catalyst, but the setup, the overextended positioning, the FOMO buying, the parabolic price action, all of that had been building for days, and Kiyosaki saw it. He warned about it explicitly, and then it happened exactly as he described. December 31st, silver extended losses to trade below $72, from $84 to $72 in 3 days, a 15% correction from the peak in 72 hours. The people who bought silver at 83 because they were afraid of missing the move to 100 got liquidated. The people who heeded Kiyosaki's warning and waited for the crash got an opportunity to buy at 72, which is 15% cheaper than the peak 3 days earlier. And on December 29th, as the crash was unfolding, Kiyosaki posted his next target. Silver breaks 80 wow, $200 next. He did not abandon his bullish thesis. He warned about the bubble, saw the crash vindicate his warning, and then immediately reaffirmed that his long-term target remains $200. And he had previously stated that he believes silver could reach $500 from 100 within a year. So his target sequence is current prices around 70 to 80, crash, recovery to 100, move to 200, eventual move to 500. That is the roadmap he has laid out publicly. Now let me show you why that roadmap is not just possible, but increasingly likely given what has happened since he issued those predictions. Silver is currently trading around $91 as of February 28, 2026. That is above the $84 peak that preceded the crash. The correction that Kiyosaki predicted happened, the recovery has happened, and silver is now making new highs above the level where the FOMO mania peaked. That price action, crash followed by rapid recovery to new highs, is classically bullish. It shakes out weak hands, resets sentiment, and then resumes the trend with a cleaner positioning structure. The Shanghai premium at $9.38 confirmed that physical buyers never agreed with the paper price during the crash. When silver fell from 84 to 72 in Western paper markets, Shanghai was closed for Chinese New Year. Eastern physical buyers were offline. They could not bid. And when they came back online on February 24th, they immediately bid silver back to 88, paying a $9.38 premium over COMEX. That premium is the physical market's verdict on whether the crash was legitimate or artificial. Physical buyers in the world's largest silver-consuming market looked at $72 silver and said, no, that is too cheap. We will pay 88 for real metal because 72 does not reflect the cost of securing physical supply. COMEX first notice day on February 27th revealed elevated delivery demand. We do not have final numbers yet as of this recording, but early indicators suggest delivery notices are tracking well above historical norms. The pattern from January and February, where deliveries were 7 times January 2024 levels and 98% of open interest respectively, appears to be continuing into March. That delivery pressure is what creates the conditions for Kiyosaki's $200 target to become reality. When paper markets cannot deliver physical metal without raiding ETF inventories and bribing longs to drop delivery demands, the gap between paper prices and physical values widens. And when that gap widens, price eventually has to rise to close it. Let me address the criticism of Kiyosaki that has circulated because it deserves a fair response. Critics point out that Kiyosaki has made multiple crash predictions since 2022, with one analysis finding he issued similar warnings 30 times. The implication is that if you predict a crash 30 times, you will eventually be right once. And that does not make you prescient. That criticism has merit in general. But it does not apply to the December 28th warning specifically. That warning was not a generic prediction that a crash would happen someday. It was a specific warning issued 2 days before an 11% crash that cited the exact mechanism, FOMO mania, that was driving the setup. The timing was precise, the mechanism was correct, and the actionable advice, wait for a crash then go, gave his followers a clear framework for how to respond. Additionally, the critics ignore that Kiyosaki's overall thesis on silver has been massively vindicated. He has been bullish on silver for decades. He owns silver mines. He personally holds significant physical silver positions. And over the last 3 years, silver has risen from $20 to over $90, a 350% gain. Yes, he warned about crashes along the way, but his core thesis that silver is a buy and that it will reach substantially higher prices driven by currency debasement and supply constraints has been correct, criticizing him for issuing short-term crash warnings while his long-term bull thesis plays out exactly as predicted seems to miss the larger point. Now let me show you why Kiyosaki's $200 target is not just possible but might actually be conservative given the structural forces at work. The Silver Institute confirmed the 6th consecutive year of structural supply deficit for 2025, 67 million ounces more demand than supply. Mine production is increasing at 1% per year. Industrial demand from solar, electric vehicles, AI data centers, and nuclear energy is growing at multiples of that. Cumulative shortfalls could exceed 1.5 billion ounces by 2030 as renewable energy demand alone reaches 510 million ounces annually. That deficit does not close at current prices. It does not close at $100. It might not close at $200 because mine supply cannot respond quickly enough. Silver is 70% a byproduct of copper and zinc mining. When silver prices rise, most mines do not ramp production because they are not optimizing for silver. They are optimizing for copper. The supply curve is inelastic. Samsung C&T just secured exclusive rights to 100% of La Parrilla mine's output for 2 years through a $7 million prepayment facility. Tesla is reportedly doing similar direct mining deals. These are industrial users who need silver for manufacturing and who have concluded that relying on COMEX or spot markets is too risky. When the world's largest technology and automotive companies bypass exchanges and go directly to mines, it removes supply from the pool available to everyone else. Every ounce Samsung locks up is one less ounce available when COMEX delivery demands spike or when other industrial users need metal. That vertical integration trend accelerates as more companies see Samsung succeed, and it creates a structural tightening of available supply that pushes prices higher, regardless of what paper markets do in the short term. China's export licensing system, implemented January 1, 2026, restricts overseas silver sales to large state-certified producers. China controls 60 to 70% of global refined silver. Tightening those export controls creates an artificial supply constraint for non-Chinese buyers. If Chinese policy shifts toward prioritizing domestic industrial use over exports, global silver markets outside China face a supply crisis that no amount of recycling or new mine production can solve quickly. And there is precedent for this. China has used rare earth export restrictions as a strategic tool during trade disputes. Silver is increasingly viewed as a strategic material for solar, EVs, and military applications. Using export controls as leverage is not speculative. It is documented policy that is already in place and that can be tightened further at any time. Trading Keys analysis titled Breaking 100, the three-front battle driving silver into the strategic asset era, lays out the case for price bands of 100 to 120, 120 to 150, and 150 to 180. Their thesis is that COMEX delivery stress, China export controls, and inelastic industrial demand create an impossible triangle where price increases cannot quickly rebalance the market because supply cannot respond and demand cannot reduce. That impossible triangle is structural, not temporary. It exists at current prices, it will exist at 100, it will exist at 150, and it only resolves when price gets high enough that either demand destruction happens at scale, which would require silver becoming prohibitively expensive for industrial applications, or supply surges through massive new mine discoveries and development, which takes 7 to 10 years. Neither of those scenarios happens quickly. Both support sustained higher prices over the next several years. Kiyosaki's $500 target from 100 within a year sounds insane until you put it in the context of the 1979 to 1980 Hunt Brothers rally. Silver went from $5 to $50 in 18 months. That is a 10 times move. If silver goes from 100 to 500, that is a 5 times move. It is not unprecedented. It is actually smaller than what happened in 1980. The difference is that the 1980 rally was driven primarily by speculation and manipulation. The Hunt Brothers were accumulating over 200 million ounces using leverage. When the CME changed the rules to crush them, the rally collapsed. The current setup is not driven by two speculators. It is driven by structural industrial demand from sectors that cannot substitute away from silver, by supply constraints that cannot be solved quickly, and by central bank diversification into hard assets that continues regardless of short-term price movements. Let me give you Kiyosaki's complete target sequence as he has articulated it publicly. Current level around $90, near-term target $100, next target $200, long-term target $500. His timeline is vague. He has said 200 could happen in 2026. He has said 500 from 100 within a year, but did not specify when the 100 starting point gets reached. What is clear is that he views the current rally as multi-year, not multi-month. He views the corrections as buying opportunities, not trend reversals, and he views silver as fundamentally mispriced relative to its scarcity, its industrial necessity, and its monetary role as an alternative to fiat currency that he describes as fake dollars losing purchasing power. Here's my optimistic synthesis. Kiyosaki called the FOMO mania crash 2 days before it happened. He advised patience. He told people to wait for the crash, then go. The crash happened. The opportunity to go arrived. And anyone who followed his advice bought silver at 72 to 75 instead of 83. That is a 13 to 15% better entry that compounds over years. Now silver is back above 90. The correction validated his timing. The recovery validates his bullish thesis. And his 200 then 500 targets are grounded in structural realities about supply deficits, industrial demand growth, and currency debasement that are all documented and observable. I am not saying silver goes straight to 500 without volatility. I am not saying Kiyosaki's timing will be perfect on every prediction. I am saying that his track record on the December 28th FOMO warning was impeccable. His overall bull thesis has been vindicated by a 350% gain over 3 years, and his targets for 200 and 500 are not speculative moonshots. They are logical extensions of a supply-demand imbalance that gets worse every year that industrial demand grows faster than mine supply. Stay positioned, respect the volatility, and understand that the people with decades of experience and real capital at risk, like Kiyosaki, are worth listening to when they issue specific warnings at specific times. He was right about the crash, he might be right about 200, and if 200 happens, 500 is not as crazy as it sounds.